Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Jill Gragnani, head of research and client engagement with Nasdaq Dorsey Wright, to discuss U.S. markets as they continue to hit or sit at all-time highs, even with inflation data coming in as high as it has. So Jay, is it just pockets of the market that are doing well, or are you seeing broader participation?
Yeah, Jill, great to be back. Thanks for having me on. And you're right. I mean, you look at the market and we continue to see the market hit close to and just, backing off a little bit, but very, very close to those new all-time highs. And it's very different, really, than what we saw in some respects last year and over the past few years, where it's been a market that has been hitting new highs, but in doing so with very few or smaller number of stocks driving those rallies and maybe not even hitting new highs. It was for quite some time a few big mega cap and specifically mega cap technology names that were really the driving force behind a lot of the market returns. And that's really been different what we've seen coming out of the back half of last year and so far through almost the first half of this year is we've just seen a lot of participation in the market as from all areas, not just the large cap growth space, but we've seen small caps, we've seen value stocks come back into favor. And to put a little bit of that into perspective, when we look at the market today, one of the ways that we can measure general participation and general strength in the market is just looking at the number of stocks in the S&P 500 that are in positive trends. And the market being at new all-time highs means the index is at new all-time highs. But what we also see is nearly 90% of all the individual stocks inside the S&P 500 are trading in positive trends today. That is a very healthy sign. Historically, anything above 50% is a very healthy sign for the market. As you look out at the market today, being that we're almost 90%, again, is a positive sign for the market, and also speaks to just the general breadth of participation that we've seen. Additionally, you mentioned, asked the question about, is it just one or two areas? And so, no, I mean, it's been a lot of areas, and to the extent that 6 out of the 11 broad sectors this year are outperforming the S&P 500, which is very different than what we've seen in years past. So a lot of strength really across the board.
So Jay, which sectors are outperforming and what's the top performing sector?
Yeah, interestingly enough and surprisingly enough, energy so far this year has been the best performing sector. And I say interestingly and surprisingly enough, if you look back over the past 7 years, I mean, energy has been the worst performing sector in 6 out of the past 7 years. However, this year, that dynamic has really flipped on its head and really changed as the best performing sector this year. Just looking at the energy select sector spider up about 48% year to date as we're reporting this. And it's really not even close in terms of leadership. The next best performing sector is financials, which is about 20 percentage points below that. So while there is broad participation in the market, and I should mention that all sectors are showing positive returns so far this year, the leadership really is within energy specifically from a sector perspective. But if you look at energy and financials, up there towards the top, we've seen this year the more value-oriented sectors have really provided the leadership trends, which again is very different than things that we've seen in years past. Whereas the technology, the largest sector or most important sector for the S&P 500 right now, given its weighting in the S&P 500, the large cap technology sector is for the first time in about 7 years actually underperforming the S&P 500 this year. That you have to go back to 2013 to see a whole calendar year where technology has underperformed the S&P 500. It's outperformed for basically the past 6 years now. So very different dynamic and a lot of leadership trend changes that we saw earlier in this year towards those more value-oriented areas.
And Jay, to wrap up here, outside of equities, where else are you seeing strong participation?
Yeah, and some of that plays back into the equity market, the fact that energy is the best performing sector. The other asset class that has really shown a lot of strength this year has been that of commodities. And it's not, once again, not one or two areas, but really broadly speaking across the commodity markets. And commodities as an asset class are or the second ranked asset class within our asset class ranking tool of Dolly. So from a relative strength perspective, they have certainly moved up in their importance, but they've also certainly been very visible in the market with things like the cost of lumber. Lumber has pulled back here recently, but over the past year is up well over 100%. You see other areas, a lot of energy commodities, crude oil, heating oil, natural gas. As this reopening of the economy continues, the demand on energy is just seemingly continuing. But you go down the spectrum and look at a lot of different commodities out there, and they've been strong really across the board. There's only been one or two out there that really haven't performed in a positive manner this way. So commodities as an asset class is another area that we've seen a lot of strength in addition to just the leadership trend of U.S. equities. So, commodities is certainly something that, as you mentioned at the beginning, the inflation numbers coming in, certainly seeing signs of inflation, and you're seeing that show up in the performance in the movement of a number of individual commodities, energy certainly being right there at the top of the list as well.
All right, Jay, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.